Welcome back to the AG Insider. This is Captain Silver, and the silver market is standing on the edge of a cliff today. And all it takes is a 25% trigger to cause the greatest physical bank run in financial history. We are not talking about a gradual decline. We are not talking about a slow transition. We are talking about an instantaneous collapse of the entire paper silver pricing system the moment that 1 in 4 contract holders wakes up and demands physical delivery. The math is absolute. The numbers are public. And the trigger threshold is so low that a single geopolitical event, a single institutional panic, a single shift in sentiment could set off a chain reaction that destroys the credibility of the COMEX overnight and sends physical silver premiums into the stratosphere. If you are holding paper silver right now, if you are trusting that your ETF shares or your unallocated pool account actually represents real metal sitting in a vault with your name on it, you need to understand that you are playing Russian roulette with your wealth. Because when the 25% trigger hits, when the bank run starts, there's not going to be enough metal to go around, and the people holding paper promises are going to be the ones left holding nothing. The suits want me to tell you this is not financial advice. And they are absolutely right. This is not financial advice. This is a mathematical warning that the fractional reserve silver market is on the verge of catastrophic failure, and you need to get your wealth into physical metal before the system breaks. Let me know in the comments below right now, because this is the most important question you need to answer honestly. If you hold a paper silver ETF like SLV, if you have an unallocated account with a bullion bank, if you own futures contracts that you plan to roll forward instead of taking delivery, are you confident they actually have your metal? Are you confident that when you decide you want physical delivery, they are going to hand you the silver? Or are you starting to realize that you might be holding a digital illusion, a database entry that says you own silver but does not actually give you any claim to physical metal when the crisis hits? Drop a comment right now. Tell me what you are holding. Tell me if you have ever actually tried to convert your paper silver into physical delivery. Because I guarantee most of you have not. And the reason the fractional reserve scheme works is because most people never test the system. Most people never demand their metal. And the banks are counting on you to stay complacent right up until the moment it is too late to get out. Now let me translate the institutional math that I have been talking about for the retail investor, because this is critically important, and this is something that most people do not understand. There are 429 million ounces of paper silver contracts floating around in the market right now. These are futures contracts on the COMEX that represent legal claims to physical silver. When you buy one of these contracts, you're buying the right to take delivery of 5,000 ounces of silver at a specified price and a specified date. Most people do not exercise that right. Most people just trade the contracts. They speculate on the price movement. They settle in cash. They roll their positions forward. But the contract gives you the legal right to demand physical delivery, and the COMEX is obligated to provide that silver if you stand for delivery. Now here is where the math gets terrifying. The COMEX vaults currently hold approximately 85 million ounces of registered physical silver. Registered silver is the only category of silver that can be delivered against futures contracts. There is also eligible silver, which is silver stored in COMEX vaults, but not available for delivery unless the owner decides to convert it to registered. But right now, today, there are only 85 million ounces that can actually be delivered if contract holders demand it. So we have 429 million ounces of paper claims and 85 million ounces of physical metal. That is a ratio of roughly 5 to 1. For every physical ounce in the vault, there are 5 paper claims on that same ounce. This is a fractional reserve system, and it operates on the exact same principle as a fiat bank. Your bank does not actually have all the deposits sitting in the vault. They lend out most of the money. They keep a small fraction in reserve. And as long as everyone does not show up at the same time demanding their deposits, the system works fine. But what happens when everyone shows up at once? The bank fails. The bank does not have the money. The FDIC steps in. Depositors lose their savings. This is called a bank run, and it is the nightmare scenario for any fractional reserve system. And right now, we are watching the conditions align for a bank run on the COMEX silver vaults. The geopolitical situation is deteriorating. We have kinetic war in the Middle East. We have the Strait of Hormuz under threat. We have oil heading toward $150 a barrel. We have energy costs exploding. We have stagflation accelerating. We have currency debasement accelerating. Every single one of these factors is driving institutional money and retail investors into safe haven assets, into physical precious metals. And the more people who decide they want physical delivery instead of paper exposure, the closer we get to the 25% trigger. Let me explain what the 25% trigger actually means. If 429 million ounces of paper claims exist and only 85 million ounces of physical metal exist, then the breaking point is when the delivery demands exceed the available supply. 25% of 429 million ounces is approximately 107 million ounces. If 107 million ounces of delivery requests come in, the COMEX cannot satisfy that demand. They only have 85 million ounces. They are short by 22 million ounces. And that is assuming that every single ounce of registered silver is actually available, which it probably is not, because some of it is already allocated to previous delivery requests. So the real trigger threshold is probably lower than 25%. It might be 20%. It might be 15%. Nobody knows the exact number because the COMEX does not publish detailed real-time data on how many ounces are already spoken for versus how many are truly available for new delivery requests. But what we do know is that the threshold is well below 50%, which means this is not a distant theoretical problem. This is an imminent practical danger that could materialize at any moment if the right catalyst appears. And here is the thing. The catalyst is already here. The massive funds holding these paper contracts are watching the same geopolitical news that you are watching. They see the Middle East war escalating. They see oil spiking. They see the energy crisis unfolding. They see currencies being debased. And they are starting to ask themselves the same question you should be asking. Do I really want to hold paper exposure to silver, or do I want the actual metal? Because if the financial system freezes, if there is a liquidity crisis, if there is a bank holiday, if there is capital controls, paper promises are not going to protect you. Only physical assets are going to protect you. So what happens when 1 in 4 of these institutional contract holders decides they want physical delivery? What happens when pension funds and sovereign wealth funds and hedge funds start standing for delivery instead of rolling their contracts forward? The COMEX cannot deliver. They do not have the metal. And when they cannot deliver, when they default on their obligation, the entire credibility of the paper-silver market collapses instantly. Because if you cannot trust the COMEX to honor delivery requests, why would anyone trade COMEX futures? Why would anyone accept the COMEX price as legitimate? The answer is they would not. And the moment that confidence is lost, the paper price becomes irrelevant, and the only price that matters is the physical price, the price you have to pay to get actual metal delivered to your door. And here's what most people do not understand. Paper silver operates on fractional reserve because it assumes most people will never demand physical delivery. It assumes that most participants are just trading the price, speculating on the movement, settling in cash. But that assumption breaks down at crisis. That assumption breaks down when people lose confidence in the financial system, and everyone rushes to convert their paper claims into physical assets all at the same time. This is the bank-run dynamic, and it is exactly what happened with banks during the Great Depression, exactly what happened with gold in 1933 when Roosevelt confiscated it, exactly what happened with every fractional reserve system that has ever existed when confidence collapsed. Financial advisors are going to tell you that paper ETFs are safe because they do not understand the physical shortage. They do not track the COMEX vault data. They do not understand the fractional reserve dynamics. They do not realize that SLV and the other silver ETFs are also operating on the assumption that most shareholders will never redeem their shares for physical metal. The prospectus allows cash settlement. The prospectus has force majeure clauses. The prospectus has all kinds of legal escape hatches that allow the fund to avoid delivering physical silver if circumstances make it impractical or impossible. And guess what circumstances make it impractical to deliver silver? A shortage, a bank run, a physical squeeze. Exactly the scenario we are heading into right now. If this channel's mission to educate the real stacking community helps you understand the difference between paper illusions and physical wealth, if it helps you get your money out of the fractional reserve system before the bank run starts, then consider hitting that super thanks button below to support this work. This is how I fund the research. This is how I stay independent. This is how I keep telling the truth that the mainstream financial media refuses to tell you. Now let me give you the action plan because time is running out and you need to understand exactly what is going to happen when the 25% trigger hits. The paper spot price of $84.50 that you see on your screen right now is an illusion that is about to disconnect violently from the real physical premium. The spot price is determined by paper trading on the COMEX and the futures exchanges. It is determined by algorithms and speculators and institutional flows in the derivatives market. But the physical price, the price you actually pay to get coins or bars delivered to your possession, that price is determined by real supply and demand in the physical market. And right now, there is already a significant disconnect. Physical premiums are $6 to $10 over spot depending on what product you are buying and where you are buying it. That premium exists because there is not enough physical supply to satisfy demand at the paper price. Dealers are having trouble sourcing inventory. Mints are running at full capacity and still cannot keep up with orders. Refineries are backlogged. And this is before the bank run even starts. This is before the 25% trigger hits. This is just the baseline stress in the physical market caused by normal investment demand and industrial demand. Now imagine what happens when the institutions start fighting for physical ounces. When pension funds and sovereign wealth funds and hedge funds that are holding hundreds of millions of dollars worth of paper silver contracts all decide at the same time that they want physical delivery. They're going to go to the COMEX first. They're going to stand for delivery on their futures contracts. And the COMEX is going to try to deliver. They are going to pull from the registered inventory. But very quickly, they are going to run out. The 85 million ounces are going to disappear. And when the registered inventory hits zero, when there is no more silver available for delivery, the COMEX is going to have to either default or find silver somewhere else. So where do they find it? They go to the retail market. They send their procurement teams to bullion dealers. They start buying every coin, every bar, every ounce they can find. And when institutional money starts competing with retail investors for the limited physical supply at dealers, the premiums explode. You think $10 over spot is expensive? Wait until the premiums are $30 or $50 or $100 over spot because JP Morgan and Citibank and HSBC are desperately bidding for physical silver to cover their delivery obligations. Wait until retail dealers are completely sold out because the institutions bought everything. Wait until you cannot get silver at any price because there is simply none available in the retail market. This is not hypothetical. This happened in March 2020 during the COVID panic. Silver dropped to $12 on paper, but you could not buy physical silver anywhere near $12. Dealers were charging $18, $20, $25 because the refineries were shut down and the supply chains were broken and everyone wanted physical metal at the same time. The premiums went vertical. And that was just a temporary supply disruption caused by a pandemic. Imagine what happens during a full-blown bank run on the COMEX when the institutions are scrambling to cover hundreds of millions of ounces of delivery obligations and there is not enough physical supply in the entire world to satisfy that demand. The only defense is to take physical possession of your silver right now, today, before the 25% trigger hits and the institutions wipe out the retail market. Do not wait for confirmation. Do not wait for the mainstream media to report on the COMEX vault depletion. Do not wait for your financial advisor to tell you it is time to move into physical. Because by the time those things happen, it will be too late. The premiums will already be at levels that make it unaffordable. The dealers will already be sold out. And you will be stuck holding paper promises that are worth nothing. I am going to be tracking the physical vault inventories and delivery demands every single week as this crisis unfolds. The registered inventory at the COMEX is updated daily, and I am watching it like a hawk. Every million ounces that leaves the vaults, every delivery request that gets filled, brings us closer to the breaking point. We are at 85 million ounces today. If that drops to 70 million, we are in dangerous territory. If it drops to 50 million, we are on the edge. If it drops below 25 million, the bank run is imminent, and there is no stopping it. Make sure you are subscribed to this channel with the bell notification turned on, because when the COMEX delivery system freezes, when the registered inventory hits critical lows, when the institutions start publicly fighting for physical metal, I am going to be putting out emergency alerts immediately. You need to be positioned before that happens. You cannot wait until after the bank run starts to try to acquire physical silver because there will not be any available. Here is the bottom line, and this is the fundamental truth that every silver investor needs to understand. True wealth is held in your own hands, not on a broker's screen. A database entry that says you own silver is not the same as having silver coins in a safe in your house or in a private vault facility that you control. Paper promises can be broken. Contracts can be defaulted. ETFs can settle in cash. Banks can freeze accounts. Governments can impose capital controls. But physical silver in your possession cannot be confiscated, cannot be rehypothecated, cannot be lent out, cannot be seized by a counterparty. It is yours. You control it. And when the financial system is in crisis, when the bank run is happening, the only wealth that matters is the wealth you physically possess. The 25% trigger is not a distant threat. It is a mathematical reality that could materialize any day if the geopolitical situation continues to deteriorate and institutional holders decide they want physical delivery. And when that trigger hits, when the bank run starts, the paper silver market is going to implode and the physical premiums are going to explode. And the only people who are going to preserve their wealth are the people who already hold physical metal. I just posted my exact strategy for stacking the most liquid physical silver coins before the premiums explode to my private insider community. I broke down which products to prioritize for maximum liquidity. I explained why certain coins trade at tighter premiums than others. I showed you which dealers still have inventory at reasonable prices. I gave you my allocation strategy between different denominations and different products. If you want to see exactly how Captain Silver is positioning for the COMEX bank run, if you want access to the weekly vault tracking updates, if you want to be part of a community that understands the difference between paper wealth and physical wealth, click the join button below and become an insider member right now. The people who join today are going to be the ones holding real silver when the fractional reserve system collapses. Do not let the 25% trigger catch you holding paper illusions. The bank run is coming. The math is certain. And the only defense is physical metal in your own hands. I will see you in the next video when we track the registered inventory and monitor delivery demands as we count down to the greatest bank run in precious metals history.